In this video, we're going to talk about this guy. This is former Instacart CEO Apoorva Mehta. He founded Instacart back in 2012, and it just went public on the Nasdaq Stock Exchange, making him a billionaire quite literally overnight. Let me let that number sink in. $1 billion. For reference, the average salary in the US is $60,000 a year. So if the average person worked for 16,666 years, they would just about break even with what Apoorva made overnight, which is absolutely insane if you think about it. Let's talk about where that absurd amount of money comes from and just how this one guy could get so much of it. To get to that point, we need to start at the beginning of Instacart and Apoorva's journey. Apoorva, along with two others, Max Mullen and Brandon Leonardo, formed Instacart back in 2012. Like many other technology companies, they formed as a C corporation. There are, many reasons to do this, but one of the primary ones is to be able to allow shared ownership of the company in the form of, shares. When a company is first starting, those shares are worth basically nothing, but the hope is that, your company becomes successful and goes public, and then those shares start having a real monetary value associated with them. You can then, sell those shares for cash, and we've essentially just described what the stock market is all about. So when Instacart first started, the distribution of shares could have looked something like this, where each founder takes an equal split, so they divide up 100 by 3, and you get 33.33% per person. If you're really trying to make your company grow though, like Instacart wanted, you're going to need more than just 3 founders to make that happen. In addition to those 3 founders, you'll have employees, advisors, investors, etc. So what usually ends up happening is the shares get divided into 3 pools. You have one pool of shares that's, for the founders, split up just amongst them. Then you have another pool of shares that's, for future employees, advisors, consultants, etc. And then that third final pool of shares for, outside investors. The distribution of these pools can, obviously vary from company to company, but for tech companies, and especially in their early stages, a pretty typical split looks something like this, where the founders pool is by far the largest, at 80% of the total shares. And then the other 2 pools split the remaining 20% at 10% and 10% apiece. Now, let's think about that for a second. You've probably heard, stories about relatively ordinary people, just regular software engineers, making a fair amount of money from tech, right? And buying, pretty nice houses and cars. Now, a lot of that money comes from the stock from those companies, but the employees only get to pull from that 10% pool. And, these companies, if they end up going public, will have thousands, if not tens of thousands of employees. And it's usually not an even split. Like an earlier employee is going to get a proportionally much larger percentage of the company's stock than someone who joins much later. But still, if you are a really early employee, let's say you're engineer number 1 at a startup, you're actually pretty lucky if you get 1% of the company's stock. Like that is extremely generous as far as these deals go. And, if we compare that 1% to the 33.33% that Apoorva gets, that should start to give us our first hint of just how large a piece of the pie Apoorva, or really any founder, gets for their company. So once you factor in the shares reserved for employees and outside investors, etc., this is what the distribution of shares looks like now. Just under, 27% for each of the 3 founders, 10% for, the future employees, etc., and 10% for, outside investors like venture capitalists. Over time, that distribution is likely going to, fluctuate a bit because you're going to run out of shares and you're going to want to keep pushing the company forward and, hopefully maybe go public someday. You'll want to do things like raise more venture capital money or hire new executives. And you're going to have to compensate all those people for what they're giving to the company. And they're going to demand more stock in order to, be invested in driving the company towards success. So then what happens is, you issue more shares than what you started with, in order to give these people something, which ends up diluting the shares of people who were already given stock. Over the many years of doing this, raising more money, hiring more top-level people, etc., you might end up with something that looks like this, where, Apoorva has, in this case, 10% of all the company's shares. So 10% of the company's equity. So then, when Instacart went public, and you can look at the company's SEC filing if you want to go really deep, the company was valued at $9.9 billion. which, if you take 10% of that, which is Apoorva's slice, is $990 million. Which, is how much Apoorva's net worth, is estimated to grow by. And so now his net worth is about $1.1 to $1.3 billion. And there you have it. The reason I, go into all of this detail is because while I think it's relatively common knowledge, that tech people can make a lot of money, I think it's, a little less common knowledge of just how this all happens, where it even comes from. How does this massive amount of money happen, especially for those, at the very top. Anyway, I hope I was able to help demystify the case for Instacart and its former CEO, Apoorva, but also, help demystify how this happens for others out there as well. As always, if any of this was interesting to you, please feel free to like the video, subscribe to the channel if you want to hear more from me. That's it for now. See y'all later.